borrowing money is like loading up your backpack with rocks. And so you load your backpack with rocks and you start off crossing the stream because you think it's shallow. But you come to one low spot and you sink. And you drown because of all the rocks in the backpack. Now, what is that low spot in the stream? It's the day that the interest rate on your loan goes from 3.5 to 7.5. And you can't carry all those rocks.
Mr. Marks, it's an honor and privilege to have an interview with you today.
Thank you. It's very glad to have you here. Well, I'm Howard Marks. I'm the co-founder and co-chairman of Oaktree Management, which is a global alternative investment firm with a specialization in credit.
I mean, your memo is so famous, so everyone who are interested in investment, they are, reading it, right? And through the memo, you have been recently said the era of low interest rate is over. And it means, I guess, the investment paradigm is shifting. So given the general market outlook, the interest rates have now peaked and people expect to decrease. What level are they expect to settle at, and how should investment principles change if that low interest rate do not return?
You know, I put out a memo just over a year ago entitled Sea Change. And a sea change is a significant, fundamental, lasting change. And I talked in there about my belief that after a very long period of either low or declining interest rates, starting in 1980, that most people in this business have ever seen is declining interest rates and ultra low interest rates. My belief is that it's over. One of these days, when the Fed declares victory against inflation, it will reduce rates a little bit, gradually. But in the period 2009 to 2021, the Fed funds rate averaged 0.5%. And my thesis is that we're not going back there. And in fact, in the memo of last December, I said, and I'm somebody who doesn't believe in forecasts, especially my own, I said that I believe that interest rates, the Fed funds rate going forward for the next 5 or 10 years, will be between 2 and 4, not between 0 and 2. And that's about as precise as I can be, but that's a big difference. The interest rates at 0.5% had a very profound impact on the economy, on the investment environment, on what succeeded and what failed. And I think that the environment will be very different, which means that the results will be very different in the years ahead.
Can you tell us then what level would interest rate will settle at, just roughly?
Well, as I said, between 2 and 4.
Between 2 and 4.
Actually, I would rather say, having had another year to think about it, between 3 and 4.
And then how, in response to that kind of interest rate changes, elevated situation, what kind of investment paradigm should be followed up?
Well, let's say I offer to lend you money with no interest. In other words, I'm giving you the use of my money. That means that you'll take my money. That means that the interest rate of 0 helps you, hurts me. I get nothing from it, and you get all the gains. And the interest rate was actually 0 for the Fed funds rate. Most people can't borrow at the Fed funds rate, but they borrow at a nearby rate. And the Fed funds rate was 0 from 08 through into 2016. It benefited the borrower. It penalized the saver or the lender. By the way, the yield on cash in the bank was a 0 for most of this period. So if you were a retiree and you've been fortunate enough to be able to save up $500,000, you got no return on it. Normally, you should get, let's say, 4% or 5%. You should have an income of $20,000 or $25,000 a year. In this environment, you got 0. So the policy decision to have 0 interest rates penalized you. and made it very tough for the saver. It penalized the banks. It penalized the insurance companies. Insurance companies enter into contracts based on paying out essentially a certain rate of interest, annuities, other investment type products, guarantee a rate of return. If the return that the insurance company can get safely goes from 5 to 1, as it did on treasuries, then the insurance company has to scramble and maybe take extra risks, fulfill its contracts. So in many ways, it's very bad for the saver or the lender, and very good for the borrower. And leveraged investment strategies basically came into existence in this period since 1980. And with the cost of capital declining steadily, they were successful. It shouldn't be a surprise. They were in an ideal environment for borrowing to invest. My premise is, in the years ahead, interest rates will not be declining and will not be close to zero. For the entire period, 09 through 21, the Fed funds rate averaged 0.5%. I don't think we'll see that again. So the subsidy that was taken out of the saver and lender's pocket and put into the pocket of the borrower, I don't think is going to repeat.
I see.
So leveraged ownership strategies should be less successful, and lending strategies should be more successful. That's the whole premise, and I don't think it's mysterious, and I don't think it's in doubt.
But from a different perspective, if interest rate remains elevated, in a high level, then it can give challenge to household and business, because they need to bear much more interest burden. To what extent is a crisis or any credit crunch do you expect? And especially regarding commercial real estate loans, which are frequently discussed as a potential trigger.
First, it's really important to clarify, and everybody says to me, they read the sea change thesis and they say, oh, you mean higher for longer. It's important that your readers, viewers, whoever they are, understand these are not high interest rates. They're higher than they used to be, but they're not high. If you look at the current rates in the sweep of history, if the Fed funds rate ends up at 3 to 4, let's say, that's low relative to most of history. It's only higher than the ridiculously low rates that we had for several years. So I don't think that the interest rates of 3 or 4 are going to pose difficulties in general. The people who borrowed a lot of money at floating rates on the assumption that they always would stay down at the floor, those people may be hurt. So who's in that category? People who bought a house using a floating rate mortgage. Well, that's the main example with regard to individuals and households, or investors who bought assets with maximum leverage premised on the fact that the base rate would be close to zero. They will have a difficult time because, let's say you have capital of $1 million. You find a company where you can make 6% a year, and you can borrow at 2% a year. So you borrow as much as you can, you invest, you buy as big a piece of that company as you can. Okay. But now what happens if the interest rate on your borrowed money, rather than 2, goes to 7? Now you're losing money. And your company cannot pay enough cash distributions to service the loan. And when the loan comes due, let's say you had $1 million of capital, you borrowed another $1 million to make your investment. You invested 2. When that loan comes due, you go to the bank to renew it. And the bank says, no, obviously, this company can't pay out enough to service the loan. We're not going to renew it. Or maybe we'll only renew half of it or a quarter of it. So the point is, And the same with the household owner. If the homeowner went to the bank, he said, what do you want for a mortgage? They said, from you, we want 3.5%. By the way, in 1980, I had a loan, and the interest rate was 22.25%. And in 2020, I was able to borrow at 2.25%. Now, most people can't borrow at 2.25%, but people went to the bank, and the bank said, we want 3.5%. And the guy says, well, here's my income, here are my assets. What's the biggest loan I can get? I want a great house. So the bank looked at it. He said, well, we'll lend you $1 million. And he went out and he bought a house. Maybe he had $500,000 in the bank. He took that out. He borrowed $1 million. He bought a house for $1.5 million. He's got a beautiful house. It's the best house he could dream of. But now the interest rate on the mortgage has gone from 3.5% to 7.5%. He can't afford it. His income supported borrowing $1 million at 3.5%. It doesn't support borrowing $1 million at 7.5%. What does he do? He loses the house, maybe. One of the biggest mistakes that investors make, and people in general, is believing that things are good and will always stay that way. Or that interest rates are low and they'll always be low. One of my favorite sayings, I don't know if you know that in college I minored in Asian studies, learned to think a little bit along those lines. So one of the things I say is never forget the man who was 6 feet tall, who drowned crossing the stream that was 5 feet deep on average.
We read that lines in the memo several times.
Yes, well, it's one of my favorites. It's one of the best sayings in this business. But, you see, borrowing money, you have a backpack. Borrowing money is like loading up your backpack with rocks. And so you load your backpack with rocks, and you start off crossing the stream because you think it's shallow. But you come to one low spot, and you sink. And you drown because of all the rocks in the backpack. Now, what is that low spot in the stream? It's the day that the interest rate on your loan goes from 3.5% to 7.5%. And you can't carry all those rocks. So the prudent person tries to strike a balance of benefit and risk. Trying to maximize the benefit, regardless of the risk, is how people get into trouble. Borrowing the most you possibly can when interest rates are extremely low is one of the easiest ways to get into trouble. And these are lessons that people have to learn over time because they forget.
Thank you. And next question leads to the investment target. I mean, after the new normal, like not high, but normalized maybe interest rate. So the core content, the latest memo emphasized a shift in the investment perspective from stocks to bonds because of the stability and the higher yields offered by the bonds. So in a high interest rate environment, what should be the target, yield that you expect will be relevant? And how much real yield should be expected, considering the anticipated inflation?
Well, first of all, I can't tell people what their right target is. I always say that's like if you go to a doctor and you say, do you know any good medicines? You have to tell the doctor what your condition is, and then hopefully he'll have a good medicine for you. You have to tell him what condition you're trying to treat. The proper goal depends on each person's situation, their age, their wealth, their income, their needs. Do they have dependents? Are they near retirement? And very importantly, how strong is their stomach? Because the more risk you take, in the long run, perhaps you'll make more, but the more uncertainty and volatility you'll deal with. And some people, it's not right for them, because if you have a weak stomach and you make a risky investment to try to get a high return, but you have a bad day, maybe you sell out because you're panicked. You have to be strong in order to be a good investor. And you should not overestimate your strength and get into risky investments that exceed your ability to carry them. But look, if you look at the Standard & Poor's 500 stock index, which is the main benchmark in the U.S. for the stock market, it has returned about 10% a year for the last century on average. And most individuals would not put all their money in the stock market. They would keep some in cash or in a bank or in bonds or treasury bills. And so most people probably shouldn't aim for 10, but maybe the individual can aim for 7 with a mix, with a diversified portfolio of bonds and safer stocks and safer assets. The point is this, though. Today, on what we call credit instruments, that is lending to corporations, we think we can get close to 10% a year on liquid investments that can be sold any day. And the professionals like me can get more than 10 on illiquid investments, which you can't sell. Most individuals, that's not appropriate. But for example, in U.S. high yield bonds, today you can get a yield of approximately 8. Now you're going to pay some fees. You're going to occasionally have some credit losses. You probably net 7. 7% is a nice return. And the point of the memo is that now you can get that in fixed income securities, not stocks. And I want everybody who's a consumer of this interview to understand the difference between stocks and debt instruments. If I have a bond or a loan or a note or a credit investment, those are all different words for very similar things. What it means is that I have given you money and you have promised me interest every 6 months, and then you have promised me that at a certain point in time you'll give me my money back. It's a legal contract. You have to do it. And if you don't do it, you probably go bankrupt, and in theory, I get the company. All your company passes to all the people you owe money to. Bankruptcy. So you have a lot of incentive to pay me. And I've been involved in bond investments since 1978. That's 45 years. And I have found that they are much more reliable. They don't have higher return than stocks. Stocks do much better when they do well. They do much better over time. But bonds are much more dependable. If you invest in 8% bonds, you're very likely to make no less than 7 over time. And 7 is a good return.
It might sound a bit rude, but telling someone to buy a bond could be misinterpreted as telling them to cut down the investing dream. So you should settle for the guaranteed but limited returns. So how do you think about that?
That's why I say it all depends on your situation. You use the word dream. I'm not a dreamer. You may be a dreamer. If you're a dreamer, you probably shouldn't buy many bonds. But if you are older, like me, if you have some money saved up, close to retirement, if you follow your dream and invest in the stock market, and it doesn't work, you may need that money for retirement, and it's not available to you anymore. You've lost it. Or you can live, but the key is to understand that in the world of investing, there are cycles. In the market, there are cycles, ups and downs. Normally, there's what we call a positive underlying trend with oscillations around the trend. And if you wait long enough, the next high is probably higher than the last high. If it goes down and you wait long enough, it'll probably come up and go even higher than when you bought, if you can wait long enough. If you're old, if you're close to retirement, if you, again, have a weak stomach, You may not be able to hold, in which case you should not invest heavily in risk assets. It all depends on what's appropriate for the individual. Everybody talks about the stock market. Should you go into the stock market or should not? Which stock should you buy? Should you buy this one or that one? These are not the important questions. The important question is for every individual to sit down and have a conversation with his partner or himself or his children or his advisors to figure out what kind of investing he or she should do. Should you take risk? In Las Vegas, at the blackjack table, they say the more you bet, the more you win when you win. And you can't argue with that. They don't say, and the more you lose when you lose. So for every investor, the question is, should you be aggressive or defensive? And in what balance? Every investment portfolio should include elements of both. But think of a speedometer in a car, which goes from 0 to 100. 0 is no risk. 100 is maximum risk. You invest all your money in risk assets. Maybe you borrow some more money to invest. That's called leverage. Where between 0 and 100 should you be? You have to figure that out. And you have to be honest with yourself and not deceive yourself. And, I remember back in '99, we had something called the tech bubble.
Yes.
And the tech stocks were going like this, and especially internet but also e-commerce. Stocks were going crazy. And you know what people said? I've made so much money, I wouldn't mind if my account went down 40%. Believe me, when it went down 40%, they minded. It's very easy in the good times to be confident that you're strong and you wouldn't mind losses. But it's not realistic. Everybody has to be realistic about if your listeners get one thing out of this podcast, webcast, whatever it's going to be, it should be that they should spend most of their time figuring out their proper risk posture. Not should you buy Microsoft or Google. What should be your risk posture?